Good afternoon to all grade 12s tuning into this afternoon's session on accounting. It's quite amazing to know that within 8 months from now you will be out of school already and preparing for your final exam. I'm hoping to explain certain concepts about general ledgers of companies to you to make it easier. Before we start, a few things on just some tips on how to be successful in accounting. I think from day one, a thorough understanding is important. You need to first understand before you can practice. It's hard to actually attribute a value to that, but maybe about 70% is understanding, and then the 30% is the practice, practice, practice every day. The problem is if you start practicing or actually understanding by October, by then you should understand very well already, and you should also have done your daily practice. Enough of that. I'm hoping that you all have your Telematics accounting book with you, your workbook. We will be looking, you will see in the front there are some tips on how to be successful in accounting, and then also a layout of what we will be doing for the next couple of weeks. And I would like you to look at that and have that with you, and also have your workbook with you and have it open. And you will see it's an activity, so we're really going to act on the questions and act on how it's done, rather than just sitting and listening to me explaining. Okay, so today we're going to look at companies and the general ledger of companies. We're going to look at key concepts such as the issuing of shares, buying back of shares, provisional tax payment, and the interim and final dividends. If you look at the activity on your sheet and you focus in on the instruction, you will see that there are certain concepts that might be strange to you. In fact, you can't just presume that anybody in grade 12 knows what a share is, or what authorized share capital is, or what a dividend is. In fact, it's a quite strange concept, something that even up until October some of you will battle with. So I've done a presentation to try and help you with understanding equity in a company and who are the people who actually own the company. Now, in your activity, you will see that it talks about Kromboom Limited. And let's say this is Kromboom Limited. And Kromboom Limited is made up of a number of shares. So somebody had a business idea, did not have enough capital to start the business, and therefore invited, in this case, because it's a public company, the public on the JSE to buy shares in the company, so that they've got enough money or raised enough capital in order to start with their activities. So Kromboom Limited has an authorized share capital of 1 million shares. But they have not issued all of them. They invited the public, let's call those smiley faces the shareholders, and they have sold shares to all of these. Now you'll see each one of those smiley faces has got either 1 or 2 or 4 share certificates or shareholding. It means that the company has taken its shareholding and has distributed to a number of owners. All of those people now own a part of Kromboom. We call those the issued shares. So notice the difference between the word authorized shares and issued shares. Authorized shares being potentially the amount of shares that they could sell to the public. But at the moment, they only needed to sell 500 shares. They didn't need to raise as much capital yet. Maybe they want to branch out later on, and at the moment, they just need to obtain money from 500 or sell shares, 500,000 shares. Okay. But now what can also happen, and this is sometimes confusing. I don't know if you noticed that. Look at that. That little share goes to that smiley face. And that share goes to this smiley face. And that share goes to this smiley face. That is trading on the JSE. And that has got nothing to do with Kromboom itself and obtaining money. The trading on the JSE is only between the different smiling faces, not between Kromboom and the smiley faces. Why would they do this? Why would they want to buy shares? Well, because there's a reward. They get dividends. They get a part of the profits, and each smiley face can walk away with some of the profits. How does that work? Let's say this bag of money represents the company profits. We have our smiley faces again with their shareholding. Remember, when each black box represents their shareholding in Kromboom Limited. When the company gets to profit sharing, which we will later look at being either interim or final, the profits are distributed in a ratio to the shareholding. So if you have 2 share certificates, you get 2 parts of the profits. If you've got 4, you get 4 parts. And that's how we distribute profits. Okay. Now, looking back at the activity again, could we have the whiteboard, please? It's important now to have a timeline. As soon as you start reading the activity, you put yourself a timeline and you look at what it is that is expected of me. Number 1, the financial year, and this is maybe an exam tip, is to write down there year end 2013, and that is in August. In many questions, some companies have a financial year end that ends on the 28th of February. Some have a financial year end on the 31st of August. So it's important that you don't get confused between your different questions. This company runs from the 1st of September 2012, or the year that we are going to account for, until the 31st of August 2013. And then I want you to look at the different activities. Over here on the 1st of September, we're going to start with balances. Then on the 14th of September, we will have our amount due to SARS paid. So I'm going to make a little note here and tell myself, remember now, I need to pay SARS and I need to pay the shareholders for dividends. Then on the 20th of January, the company paid a provisional tax of 420,000 and ordinary shares of 15 rand, and a dividend of 75 cents per share. So over here, I'm going to pay a first provisional tax and I'm going to pay dividends. On the 1st of March, the company is going to issue shares. And then on the 18th of July 2013, the company is going to buy back shares. On the 31st of August, there will be a second provisional payment. You will have final dividends, and you will have to bring in the final income tax into account, and you will have to do closing transfers. So quite a bit happening on year end. So it's important that you have a time frame of what is happening and that you maybe draw a timeline like this somewhere just on your exam pad or on your question so that you can refer back to that and make sure that you've made all those entries. Okay. Going back to the slide, you are presented with information from Kromboom Limited. And what does it say? Those balances in your activity, I've just transferred it onto the slide. It says that you've got ordinary capital of 1.5 million, retained income 526,000, then that represents your shareholders' equity. Then you also have 70,000 rand on the credit side, SARS income tax. That is an amount owed to SARS for income tax. And then you have shareholders for dividends, 325,000. That's the amount owed to the shareholders for dividends declared, but not yet paid at year end, previous year's year end. So I want us to start all together and bring down these balances from the slide that I've just given you, in ordinary share capital, we're going to bring down the balance of 1.5 million. That's 2012, September the 1st. Balance brought down, and that's 1.5 million rand. Grade 12s tuning in, you will notice that your answer sheet does not have a folio column like my answer sheet. I've just put that there because I like to refer to the folio and the origin of the amount that I've entered, but you can just put it on. And if you ever get a question paper such as this where you are not provided with a folio column, then you are welcome to just put your folio right there. So that's my ordinary share capital, 1.5 million, and that's my balance brought down. Of course, it's on the credit side because this is a balance sheet account and it's equity, and equity is positive with a credit balance. Then we have the retained income. Those are undistributed profits. And again, I bring down my balance. 2012, September the 1st, balance brought down, and that is 5,260,000. When we go to the SARS income tax account, it says that it's got a credit balance. So on the credit side, 2012, September the 1st, balance brought down, and that is 70,000. Grade 12s, you will notice on your answer sheet that you don't have an income tax account. I've just put that through for my explanation for later on. Then I have shareholders for dividends, again a credit. This is the amount that I owe to my creditors resulting from last year. Balance brought down, 325,000. And you've just earned yourself a couple of marks already because you brought down the balances on the right side. Easy, that was just information that you transferred from the question onto your sheets. And you must remember, think of the properties of the account. Is it a liability? Then it's going to have a credit balance. Is it equity? Credit balance. Or is it an asset? Then it will have a debit balance. Okay. If we look at our timesheet that we've drawn, then we're well on our way. Step number 1, bringing down balances, is done. The question now says, if you read with me, on the 14th of September, the amounts due to SARS and the shareholders were paid. That means I need to credit bank, make a payment out of bank, and debit the two liabilities. Remember, grade 12, those amounts are outstanding from last year. They're due from last year, and it's important now that before the year gets too far on its way, that I settle all outstanding amounts from the previous financial year. So on the debit side here, 2012, maybe the September the 14th, credit bank, debit SARS income tax. And that would have come from my CPJ, 70,000 rand. So this amount there is now settled. And in shareholders for dividends, 2012, September the 14th, bank, that would have been from a CPJ 325000. More marks earned. SARS is paid, shareholders for dividends are paid. Going back to my activity, I now read and I see on the 20th of January, the company paid provisional tax of 420,000 and interim dividends of 75 cents per share. Okay. Now I just want to move on to this slide here. Okay. let's just look at this, the timeline. The company is going to make 3 payments for tax during the year. We've just done the first one. On the 1st of September or the 14th of September over here, we have made our provisional payment. Now, on the 20th of January, the company makes its first provisional payment. Remember, that amount was settled. That was paid to SARS. We've just done the entry. Now the company makes a first provisional payment. Just to give you a quick understanding of this provisional story, a company, unlike a salary earner, does not know how much profit it's going to make throughout the year. So it will base its tax payments on profits made from the previous year. So let's say the company in the previous year made, I'm simplifying this, made R1 million profit and paid 400,000 tax. Then they will look and estimate what will it be this year, and then they will make 2 payments, in practice a third, but in your syllabus, for your syllabus purposes, 2 payments. The first one has to be done before a period of 6 months. So the first provisional payment is made 6 months after the start of the financial year. Now, 6 months after the start of the financial year is in March. This company made its first provisional payment in January already, and that is normal. It can happen. It depends on cash flow. You will see that some other activities happened in March, so the company made its provisional payment in January already. And then the company is going to make a second provisional tax payment, and we'll make that entry just a little later, and all of those goes to SARS. A way of looking at this is, let's say, this provisional tax story. Let's say 10 years from now, your first child is born, and it's a little girl, and you know that one day you will have to pay for the wedding of this girl. So every year on her birthday, you put some money aside. It's like a provision. When it comes to a wedding day, you will know what the actual expense is, and you will deduct that from the provision that you've made. It might be a little too little, it might be too much, but at least you've made that provision. Tax payments work like that. You make a provision for when the tax man comes and says, all right, payback time to give me time to give the king what the king should have. So that's why this is like a savings account, like putting money aside until you know what the tax man is going to assess you with. Okay, so let's make that entry for the first and the second provisional just for the first provisional payment, because we're running on our financial year. It's a simple entry. It is 2013, January the 20th, bank, via my CPJ, 420,000 Rand. Okay? But then it also says that the company paid an interim dividend. Remember now, this is where the bag of money gets distributed to the shareholders. So they take their profits and they say, shareholders, we are going to reward you for the fact that you've given us some of your money to buy machinery with and to have production going and to sell and make a profit. We're going to reward you for that, because essentially if it wasn't for your money, we wouldn't have been able to do that. And so they make a payment 2013, January the 20th, bank, CPJ, and the amount is, and now this is an amount that you now have to calculate, because remember, they're paying dividends at the moment. Right at the beginning, in the question, it says that, and remember we also had that graph, it says right there that Kromboom at the beginning has 500,000 shares issued. So each one of those smiley faces with share certificates or an indication that they own shares in the company needs to get some profit. So we're going to go 500,000 times 75 cents each. And so the amount of dividends, and these are called interim dividends, 375,000. At this point, I would like to explain something to you. I know that learners get very confused with these two accounts, shareholders for dividends and dividends on ordinary shares. This one is a balance sheet account section. Shareholders for dividends. Grade 12, this is like creditors. It's a liability to the company, and this shows the dividends still payable. Now remember, in this specific transaction that we've just entered, it wasn't necessary to put in anything in that account because we've just paid the shareholders. The next one, dividends on ordinary shares. This is a nominal account. It's closed off to the appropriation account, and this shows the total dividends for the financial year. In other words, the expense for the year. I hope that explains it a little better. So I don't make any entry in my shareholders for dividends account because I don't owe anything. I have made a payment. I credited bank and I debited dividends on ordinary shares. Going to the timeline. Doing very well. We've made our first provisional tax payment and we've paid our interim dividends. Okay. Okay, going back to Kromboom. Kromboom is now going to, if I read the transaction to you, it says now on the 1st of March, the company issued a further 100,000 ordinary shares at 15 Rand each. The proceeds of the issue were received. Remember, we said that Kromboom has the ability or the capacity to sell 1 million shares. But at the moment, they've only got 500,000 shares issued. So now we get to the point where Kromboom wants to expand. So they're going to sell off another 100,000 shares. And these are going to go to more shareholders. At the moment, we can get new smiley faces, in other words, new shareholders, but existing shareholders can also buy shares. So let's just give them their shares. You see, some of the new shares that we issue go to existing shareholders and some go to new shareholders. So that's really what happened in that that transaction. And the entry for that, ordinary share capital, 2013, March the 1st. I received the money in bank, so bank will be debited, and ordinary share capital credited. From the CRJ, 1.5 million. Grade 12, at this point, it's quite interesting to know that this represents 500,000 shares, that 1.5 million, and this represents 100,000 shares. So what obviously happened in the company is that the share price from what it originally was up until now has increased, which means the company is not doing too badly because the people are willing to pay more for owning a part in Kromboom Limited. Looking at the timeline, the new shares were issued, activity done. Now, on the 18th of July, that's just before year end, we read that one of the shareholders passed away. the directors decided to buy back his 180,000 shares at 20 Rand per share. A direct transfer was put through for this. At this point, it's important to remember, and you might remember in the movie Social Media, where the guy who started Facebook was very upset because more shares were sold, which means the profits were diluted. Remember now, the more shares out in the market, the more people to distribute the profits to. If it's just you and your brother at home and you have to share a cake, you each get half. But if your whole class is at home and there's one cake, you each get a tiny piece. So sometimes it makes sense for companies to buy back shares. In other words, and it makes their shareholders happy because there are less people who now share in the profits. So in this case, what happened was, remember we had 600,000 issued shares. Same scenario. But in the meantime, between those two slides, you will see that this shareholder here has on the JSE acquired quite a few shares. He's actually quite a strongholder there. And then, as they say in the activity, he passes away. So what happens to the company is the company decides to buy back the shares. It goes back to the company. I make it fly off the screen. And the company now has those unissued shares again. What's happened to the shareholding? The 600,000 issued shares changed to only 420,000 issued shares. Okay. Now, making an entry into your books. The question is, you're paying 20 Rand for it. What was the original price? Was it 15? Remember, you issued shares a little later at 15. What the shares that shareholder owned, what did he pay for it? Well, it's hard to determine. We're not sure where he bought his shares from and at what price. So what we do is we give it an average share price. We're going to look at, sorry, just a moment. I just want to go to the right slide. Slide 13. There we go. So we are going to buy back shares now. What happened was the shareholder originally, remember now, we have 1.5 million originally and then another 1.5, which means we have 3 million share capital, 3 million rands worth of share capital. But we need to determine an average price. Let's fade that out. The first 1.5 million represents 500,000 shares. Remember, that's what we started off with, and that's what they gave us in the balances. The second 1.5 million represents 100,000 shares, and the total means that we have 600,000 shares at 3 million Rand. So to work out the average share price, we're going to take the share capital and divide it by the number of issued shares. It's important that you write this down somewhere. Average price equals share capital being the 3 million divided by the number of issued shares at that point. What is that? At the moment, we have 3 million Rand worth of share capital, and we have 600,000 shares, which represents 5 Rand per share. Okay. So that says the company has given the share an average price of 5 Rand. This 5 Rand will be debited against the share capital account. Then the company has 15 Rand, which will be debited against retained income. And the way you can look at this, grade 12, is to say the book value of the share. Let's call it the book value of the share for the company at the moment is 5 rand. They calculated and they got to 5 rand. They're selling it, or pardon me, buying it back for 20 rand, which means that they're actually paying 15 rand more than what it is sitting in their books at, and therefore they have to debit their retained income, therefore give away some of their retained income. They're losing out on some of their retained profits in order to buy back these shares. But as I said, it's got some, there are some benefits for the company to buy back the shares, and that's why they would do that. Okay, so the entry for that would be debit your ordinary share capital with 900,000 and debit retained income with 900,000. Just have a look at this. The 5 rand, which was the average price that I gave it, is 900,000, and that goes against ordinary share capital. And then the bits of profit that you're actually forfeiting in the process of buying back shares goes to the retained income, and this 20 rand will be credited against bank. Okay. So let's do that manual entry so that your activity is also up to date. In the share capital account, you're going to debit the amount of 900,000. The entry there is bank, and you would have made that payment from your CPJ. And how did you get to that? That was the average price of 5 rand per share multiplied with 180,000 shares that you bought back. Then against the retained income account, you're going to go 2013 March the 1st, also debit bank, and that is the 15 rand per share that you forfeit, if you can use that word, times 180,000. So the company has given up 2.7 million of its retained income in order to buy back the shares. Okay. Then I'm almost done. I've bought back the shares, and now I have to enter my second provisional payment. I need to declare final dividends. I need to bring the income tax into account, and I have to do my closing transfers. So let's first make our second provisional payment for tax. If you read in the activity, they'll say that the second provisional payment on the 31st of August is 485,000 rand. So I'm going to go credit bank and debit the SARS income tax account with 2013, that's August, that's the very last day of the financial year. Bank, CPJ 485,000. Remember that little story I told you for your little girl's wedding, that you're putting money aside. So you have given SARS 420 and 485 for this year. You're not sure what your tax is for the year yet, but you have at least saved with these two amounts. Or save is the wrong term, because you won't get most of it back, but you've at least put that money aside. Then with dividends, and this is now the important one, remember they are not paying dividends, they are just declaring it. Think about it this way. If you buy stationery, cash, you're going to go debit stationery, credit bank. If you buy stationery on credit, you will go still debit stationery, but then credit, creditors control. The dividends work more or less the same. When I paid the dividends cash, I said debit, dividends, credit, bank. Now I declare the dividends, but I don't pay them. So I still, in the nominal account, I still say debit, dividends. That will be August the 31st. But instead of saying bank, I say creditors, or in this case, the creditors is called shareholders for dividends. And that will happen via your GJ. And to calculate the amount, we just need to stand still for a bit. Remember now, at this moment, we have 420,000 issued shares. Remember when we, right at the end with Kromboom, we said we now have 420,000 issued shares. So each of those shareholders, 420,000 of them, will receive a dividend of 160 cents. And you calculate that and you will get to the amount of 672,000. Grade 12, these two amounts now represent the total amounts of dividends. This was my interim and this was my final dividend. Okay. And now we have to get to the closing of the accounts. And what I'm going to do, in order for you to save time and to run me through the whole thing, I want to show you, I've done the entries on a PowerPoint slide so that you can work with me in terms of how we close this whole thing off. We are done with, on our timeline, with our second provisional payment, and we are done with our final dividends. We still have to enter the final income tax, and we need to do closing transfers. Okay, so going to the slide. Let's begin with dividends. I'm going to run you through a history of the dividends account. We started off with 325,000 Rand, and you will remember that that was the amount that was owed at the beginning of the year to the shareholders. And that amount we paid. We then went and, pardon me, and that says, if I have to explain to you in just a bulleted form, when we pay amounts to the shareholders that are due, we go debit shareholders for dividends, credit bank. So that was the first step in shareholders for dividends or regarding dividends. The next one was to say pay interim dividends. And that entry is debit dividends on ordinary shares and credit bank. Remember, that's when we went debit dividends on ordinary shares and we credited bank. And that was called our interim dividend. I've just seen a question here that says, where did I get the 75 cents from? They say that in your activity, so in the activity they actually tell you what the dividend is. You didn't have to calculate it. They tell you pay a dividend of 75 cents. The next thing that happened regarding dividends was to say, declare a final dividend at year end. That is debit, the expense account, dividends on ordinary shares, and credit, shareholders for dividends. Do you see how these two relate to each other? Because this amount here will be outstanding and will be debited in the next financial year. So the entry for that final dividend is debit, dividends on ordinary shares, but not with bank. Debit it with shareholders for dividends and credit dividends on ordinary shares, because this amount, the credit for this, the contra for this account lies in the shareholders for dividends. A question again is, where did I get the dividend from? Where did I get the 160 cents per share? That was given in the information. Okay, that's a final dividend declared but not paid yet at year end. Grade 12, and at this point, you will then close off these accounts. You will balance the B account, the shareholders for dividends, to determine what is the outstanding amount, and then the dividends on ordinary shares will be closed off to the appropriation account. Okay, so there I take this total balance to the appropriation account, and the shareholders for dividends is balance. If I had to now start Kromboom next year, the amount that they will provide me with at the beginning saying shareholders for dividends will be 672,000 Rand. So this amount will be, in the next financial year, will be their first amount to be settled with bank. Okay. Looking at the income tax. So you have the dividends and the shareholders for dividends running in combination. Then you have the income tax and the SARS income tax. Remember to understand the difference. This one is the account in which you keep your provisional payments and where you keep track of how much you owe SARS. This one is the expense account, which is closed off to the appropriation account, and this is where your actual tax liability is entered. Remember now, when we started the exercise with a balance there of 70,000 Rand. And that 70,000 Rand was paid on the 14th of September. I put that squiggly line through to show you, in other words, after the 14th of September, we were actually clear with SARS. We didn't owe them anything and they didn't owe us anything. And then, as good South African citizens, we started making our first provisional payment, Kromboom did, and the second provisional payment. And by the end of the year, we had a total, these two, first provisional and second provisional payment, money set aside for when we have calculated what our actual tax liability is. Then we go and we read in the transaction, it says the net income accounting to the profit and loss account was 2.9 million Rand, and income tax is calculated at 30% of net income. 30% of 2.9 million gives me 870,000. That is the actual expense that I put through, and I run it off that provision that's sitting there. So Kromboom has made a little bit of a miscalculation. They have under or overpaid by 35,000 Rand. And what will happen at the beginning of the next financial year is SARS will pay this amount back to them. Grade 12, this is when you hear people said that we got money back from the taxman. That's often when you've given the taxman money, or SARS, you've overpaid them because you didn't know how much you should pay them, and they're now giving you an amount back because your actual tax liability for the year was indeed 870,000 Rand and not 905,000 as you thought it would be, being the 975 minus the 70 there. Income tax in account needs to be closed off to the appropriation account. Okay. At the end of the year, as I said, the SARS will now give the 35,000 Rand back. I have a question here from Albert. Albert says he wants to know, how do we calculate the income tax? Albert, your profit for the year, which comes from your appropriation account, was 2.9 million. And the company pays at a tax rate of 30%, so you get that 30%, and then you get to 870,000 Rand, which is your tax liability, and that's why you made that entry, 870,000 there, and you played that off against the provision that you've made. Hope that answers your question. Okay. Sorry, I just want to go to the next slide now, because we need to now get to year-end procedures. If I look at this slide here, slide 14, this will maybe give you a visual idea of what happens in the appropriation account. The appropriation account is like, remember I said to you, there's that profit And profit is distributed. A part of the profit goes to dividends. A part of the profit is paid back to South African Revenue Service, and the rest of the profit can be retained in the business. The shareholders will decide how much money to retain. They don't have to pay any dividends. They can retain just a little bit. But this is more or less an explanation of what it would look like. Have a look at this. I just want to take you to another slide. Have a look at the retained income. We had, at the beginning of the year, 5.260 in the retained income. And then, remember, we gave away some of our profits because we bought back those shares. Okay. Now they tell you that the profit that was made was 2.9 million rand. And we know that the income tax portion was 870,000. We also know that the dividends, the total dividends, was 1.47 million rand. Look at this. The total profit, 2.9 million, divided into income tax of 870,000, dividends of 1.4 million, and what stays there is the 983,000 retained income. The accounting entry for that would be debit, the appropriation account, because you've balanced it off and you looked at what is left in the account, and that amount goes back into the retained income. So the company can then retain that money for future purposes. 6.243 million rand. Okay. Grade 12, the question also asks you, so this runs through the ledger accounts. Think about it, you have made the timeline entries at year end. You've done, if we look at the slide again, this is the most important part of the business, because in the end it says what happened to the profits, and you can combine this or compare this to a capital account from grade 8 and 9 and 10 accounting, from when you had a sole proprietor. The balance of capital, the profit that was not distributed, and the money that was withdrawn. So this really represents equity. How did it get there? In this appropriation account, which is the account that we use to calculate profits. So it's important that you look at this. And then the question goes on, because remember now, a business will not, this is untidy, the ledger account is untidy. A business will not provide its shareholders with its ledger account. It needs to do financial statements, which are tidy and which is the best way of looking at it. And I have presented that they ask you also to make the note for the retained income and for share capital. And I have prepared the notes for you to show you what it should look like once you've done it. And I just want to go to that slide again. Slide 15. Look at this. At the beginning of the year, the company in the retained income, this is what you will present the shareholders with, is 5.2 million rand. Net profit after tax, 2.9 million minus the 870,000. You repurchased shares, you paid dividends, and you declared dividends. And the total of those gave you your total of dividends, which also ate some of the profits, which leaves you with a profit or a balance at the end of 3.543 million. Grade 12, this is the note that you will present the shareholders with. But this will resemble your ledger account. Look at that, retained income. Again, your balance at the beginning of the year. The part that was appropriated, in other words, the profits that came to you, minus the bit that was bought back. Let's look at this. So the retained income ledger really is a replica of the retained income note. I have the balance at the beginning, 2.6 million. I have the 2.3 million minus the 1.47 million dividends, which gives me 983,000. So this one minus that one gives me 983. I have the buying back of the shares. I have my profit at the end, the balance at the end of 3,543,000. So it's important to know that the note and the ledger actually match each other. They're not two different processes. The one is just your rough work and the other one is your more tidy explanation. The same with looking at the shareholders' equity. They've also asked you to do that, ordinary share capital. This note says you have 1 million ordinary shares. You have issued 500,000 shares at the beginning of the year, and you really just tell the shareholders the story of what happened in shareholding during the year. Remember Kromboom, who was the smiley faces, what happened? You started off with 500,000 ordinary shares, which gave you a rand value of 1.5 million. You then issued an additional 100,000 shares, also giving you another 1.5 million. Then you purchased back, and the market value was 20 rand, but you diminished that amount with 180,000 times 5 rand. So you gave away share capital of 900,000, and in the end, you sit with 420,000 ordinary shares, and it is issued at year end, and the value of that is 2.1 million. Now have a look at your ledger account. It says exactly that. You started off with 1.5 million. You issued another 1.5 million rands worth of shares. You bought back 900,000 rands worth of shares. No, you didn't buy back 900,000. The average price at that point was 5 rand. And then you left with a balance of 2.1 million. Now, I see there are quite a number of questions here where people ask me to explain the 5 rand again, the average share price. So I'm going to just go back to that slide and explain that to you again. Explaining average share price. Okay. Remember, we had at the beginning, just want to run you back. We have average share, we have share capital of 1.53 million. At the time of buying back, if we can just have a look at the timeline again, if I can just have the whiteboard again. Remember, I started off at the beginning of the year with 500,000 shares. I then issued more shares here, 100,000. So in total, I now have 600,000 issued shares, and at the end, over here, I'm buying back 180,000 shares. Okay? So looking at the slide again, remember, 1.5 million plus 1.5 gives me 3 million. I now need to work out an average price because some of these shares were issued at maybe 3 rand, maybe 2 rand, and I know that these were all sold at 15 rand. So when I bought back the shares from the deceased shareholder, how do I know what price to pay for it? So I'm going to use an average price. That's why I go, that plus that gives me 600,000 shares. Write this down again. The couple of people who have asked me, where did I get the 5 rand from? I had to calculate it. I said, if my share capital is 3 million and the number of issued shares at the moment is 600,000, I say average share price is equal to share capital of 3 million divided by 600,000 issued shares, and that gives me the 5 rand per share. So I then broke that up and I said 5 rand has to be debited against the share capital account because that is the book value, let's call it book value, of the shares for me. For Kromboom says the value for those shares sitting at book value in my books is 5 rand. I'm willing to pay 20 Rand for it, because that is closely related to market value. So the difference between the market value and the book value is the 15 Rand that I can almost call it a loss on the repurchasing of the shares, and that is debited against my retained income. I hope that answers your question. Okay. Grade 12s, this exercise and this activity entails many concepts of companies. You can go and look in your activity book, there is an activity 2, and I want to challenge you to, while it's still fresh, go and see whether you can, judging on what we did today, also determine the new average price and then see how the whole thing fits in. I will soon speak to you about cash flow statements. I hope that you have had some understanding and that you've enjoyed the afternoon. Thank you for your time and your determination.